Hey, Justin, happy birthday.
Hey, thank you, Ram. How are you?
Good, man. I wasn't sure we were going to pull this off today. I was prepared to go solo, but glad you can join. I know you're going to spend time with your family later. And we're rocking this is your birthday hat of choice today.
Uh, yeah, I might get a new hat this weekend for my birthday, but I
Nice.
did throw on this hat.
What to get the guy who has everything, including a lot of hats. So
Yeah, actually, my wife knocked it out of the park. For me, I'm a Florida Gator, and this morning I unveiled something for my home gym in my home that we're renovating, which is a signed, autograph, framed Tim Tebow jersey.
oh wow.
I'm a big Tim Tebow fan.
Are you? Okay, wow.
I don't think it's too controversial to say I believe he's the greatest college football player of all time.
Well, I can't really spar with you on that topic, so I'm just going to concede and roll with it.
Yeah, there have been other great ones, but I put him up there.
I would say, yeah, I can't even go there. I know a bit about basketball, but that's about it. So
yeah, no, it's all good. It's all good. Anyway, I was super excited for that, and it was a great present. And so far, it's been a great birthday. So feeling good.
Fantastic. Well, let's dig in. We got a lot to get through today. So
we do. Goldman's following your lead finally. They're catching up to you.
Let me tell you, I bet a few DMs, let's say friendly people on Twitter. They're like, Rob, I love it how Goldman has thousands of like traders and macro people, and they get it wrong. We said no rate cuts in March. Finally, their chief economist said no rate cuts in March. They held out for a long time. Second, we said Apple does not make any sense, especially on a conviction buy. We wrote a side by side. I said, look, here's what I like and don't like. And there's some names that they have that I actually do like. It's not like I have something against. I do have something against Goldman actually, but I try to be clear. But Apple, they took Apple off the conviction buy finally. So about time, better late than never. I mentioned before, it was a podcast with Howard. I was like, look, if you want to outperform the S&P, if you own every name in the S&P and just not Apple and not Tesla, you will do just fine. And that has proven out. So, Apple shut down their AI car division, or not their electric car, to compete with that otherwise would have competed with Tesla. So Steve Jobs, I mean, man, you got to imagine this guy has taken like the Apple Vision Pro, which is a wonderful $3,500 neck brace. Like if you have an issue, you can walk around with that thing. I'm teasing here. But he's probably put it like in a fish tank. You've heard that story. He counts the bubbles that flow out of that escape the device. No, you heard the story? Okay. So the first time they had the iPhone product concept, Steve Jobs looked at it, and he's got an incredible eye for design, discernment. He walks over to the fish tank, drops it in, and looks at the bubbles coming out and says, you can do better. You can make the form factor tighter. There's air gaps in this device. You have to get the component to fit together perfectly, right?
That's amazing.
So, I think, God bless Steve Jobs. What a hero, incredible individual. I'm pretty sure right now in heaven, he's like, what the hell is going on with Apple? Man, I love my Apple products, but seriously, the car, now the Vision Pro.
Yeah.
Right? Goldman, look, better late than never, guys, but better, try harder next time.
It's tough. I don't know if it's tough if you're Apple, but it's hard to innovate as the market leader, I think. I mean, there's just a lot of inertia around your existing structure and your existing products. And so, like, I think you said this, are they innovating against themselves? Are they trying to put their own products out of business?
It's just no growth avenue. That's the issue. They've talked to their customer, and they've been incredibly successful. So successful that there's not much room to grow. There's no, the thing that Apple and all these other big tech companies can do is buy a bank, but for the fact that the bank holding company act prohibits them, they can get into financial services. I'd be long Apple. I'd be very excited about Apple. You know,
Well,
Google, right?
now you're going back to Goldman because Apple paired with Goldman for the Apple Card.
And they exited that program as well. So, you know, these big tech companies.
Goldman exited because Apple took all the economics.
Right.
Oh, the inside story on that is basically Apple reverse auctioned, sort of. I don't know all the intricacies of it, but I know that there were several banks competing for the Apple Card. And I know that as a result, Apple had pricing power, right? Like they said, look, you want a card? Well, we have all the users. So that Apple Wallet's pretty powerful. And so they controlled the economics in that deal with Goldman. And it just didn't make sense for Goldman.
Right.
And then it paired with Goldman's kind of consumer approach with, what was that, Albert? Is that what they called it?
I think that's right. Yeah.
Yeah. And like, it was just like, what a disaster. And like the whole Green Sky, Albert, Apple Card, all of that, like, lower end consumer product just didn't work. Consumer banking just didn't work for Goldman.
On this. I mean, like the leading co-brand issuers, as you know, are like Chase, who powers United Mileage Plus, Citibank, who powers American Airlines, American Express, who powers Delta, and they all have a bunch of different co-brand cards. And Goldman tried to get in the game. My first job in consulting was this whole category. So it's been one or two things, done some interesting work around there, but it's competitive, it's efficient. There's, you know, it's really hard to differentiate. And Goldman had the winning curse. If you compete to win that auction, you're winning by giving up the most economics. And of course, they're shutting that down. So Goldman got issues, Apple got issues. Dell did great. We're excited about that. Went up 27% in like the last 24 hours. That was in our conviction buys, actually. So we had it's like a top 5 position for us. Really excited. Dell had a forward PE of 13.6 just a few days ago, to put that in perspective. So we're always scanning the market and trying to find value. And, you know, Mr. Market's bid up Mag 7. There's still moves there to make. You know, we're long Meta. We love Google at this price for sure. But within that semiconductor space, Dell is actually part of that because they're a distribution partner of NVIDIA. So they're capturing share revenue. And they play an important role there, benefiting from the growth of data centers. You got to call Dell, and you're also calling Supermicro and some other players. So that was great. We like that. I had a semiconductor podcast this morning with Dan Nysedt. He lives in Taiwan. Excuse me. He's a former journalist who turned into financial analyst, focused on semiconductors. You know, lived in mainland China. Very thoughtful individual, also had interesting perspectives on China, Taiwan geopolitics. So we did that live this morning. We'll have a produced, edited version coming out in a few days. That's definitely worth checking out. You can follow it on YouTube as well. But I'm
excited to listen to that.
It's going to be really interesting. He was it was great. What's great about this is that we're learning from like the minds in the category and taking the key trends and finding, okay, what's the best way to express a view, and, you know, have not just a trend conversation, but also, hey, how do you think about, say, Broadcom versus Marvel? You know, and you're talking to someone that's got a pretty informed perspective on this topic, or like photonics and data centers. Right? So that was good. What else?
Yeah, so I was interested in the things that are going on at Snowflake. I know you were looking at that and talking about that, and you know, we share an affinity for, I guess now, the former Snowflake CEO,
Frank Slootman. Yes,
Frank Slootman. Absolutely, amp it up, man.
Right. So, you know, everyone on our team gets this book, Amp It Up. Right. We love this book. We love Frank Slootman. Right. He's great. I got a man crush on him. Right.
You do. I think I have it. I mean, I know it's right here.
So, you know, so of course you're going to look at, there it is. Wonderful book. If you're a leader, executive, you should read that book. Another great book to pair with that is The Hard Thing of Hard Things. Justin and I have to do What's on Your Mind of our top 5 books. We'll go back and forth on that. That's a great topic to go through at some point.
That's a great one, man. That's a great one.
we'll come back to that one. That'll like take up the whole hour, I'm sure. So naturally, we looked up, well, hey, look, this guy's running a business called, so let's take a look at that business. And I'll pull up Snowflake briefly on the screen, but what happened is they announced their earnings. They missed massively. The stock dropped 40%.
Yeah, they got crushed.
I think like Grim Reaper meme came out on this one. And I'm going to pull this out here. So we looked at this. You can see I did some work on this way back when. And it was an easy pass. You try to say no quickly opportunities, but this is Snowflake. It's below its IPO price. Look at that volume. Like, someone got murdered, call 911. And 194 PE. Okay, so when you look at that, all right, I might have to pass on that one. Obviously, that earnings has come down quite a bit, and you can just see some of the numbers here aren't, what we were looking for. So, but what's interesting is that Altimeter has a concentrated position in Snowflake. So, Altimeter is a venture capital fund that did extraordinarily well betting on Snowflake and other SaaS companies. They're quality venture fund. They've got a podcast I've listened to, I think 2 or 3 of their episodes. It's a new podcast with Bill Gurley. I've enjoyed it. And Brad has got a very negative view on Google. I've got a positive view, so I enjoy listening to his perspective.
Bill Gurley's a Gator, by the way, like me and Tim Tebow.
Is that right? Oh, I don't know that. Bill Gurley, benchmark capital partner, kind of like a gray-haired guy in the venture category. So I looked up to see who's got the biggest position in Snowflake. It's Altimeter. So Altimeter's got a massive, across all of their funds, public and private, 41% position. This is per SEC filings, right? There's a legal obligation to file these. We don't know how much is in the private fund, how much in the public fund. We also don't know how much they hedged. We had a quick back and forth. He said, we hedged. And the question is, well, how'd you hedge? I have a post on that today. It's not an easy thing to talk about how you hedge. It's not easy to hedge. So yeah, that's going to be, and you can see no one else really has a large position. These are not big funds. So here you've got a company that has a market cap of $61 billion with a concentrated stock position, not unlike Warren Buffett and Apple. The difference is that there's a wide buyer base for Apple. Apple actually is a good company. Apple's a wonderful business, and people believe in Apple. But here's a concentrated stock position. The revenue's declining. They got a new CEO. The new CEO, look, probably the backstory is that revenue and earnings were declining, and there was a surprise. Altimeter said, WTF, I own $2 billion of this company, and it's their number one position. They're concentrated. And they said, all right, you're the chairman now. They bought another company that they acquired, Snowflake, recently, and they put that guy as CEO now. So that's what's going on.
But what's interesting, so earlier I think you said that Altimeter is a venture capital fund. Are they a hedge
crossover?
fund?
They crossed over, hedge fund venture crossover, like a Tiger or Coach.
Yeah, exactly. So they're both. So were they in Snowflake at all as a venture backer, and then they've increased their position as a hedge fund?
I don't know if they increased their position. That's a really good question. I don't know. They made a fortune on Snowflake. The fortune that Brad Gerstner made on Snowflake is going to dwarf whatever losses they have on this hedge fund. It doesn't matter in that sense, right? They're going to have to pay the piper back. And now the market knows that this business is slowing their revenue and earnings. So they need a growth miracle, which isn't going to happen. Like Frank Slootman is a growth CEO. That's what he does. That's his specialty, growth.
Well, what's interesting to me, though, is Altimeter with a 40% position in the company essentially is the company. You know what I mean? Like, you're nearly the majority owner, not just the largest shareholder.
So Snowflake is 40% of their fund. Let me check if I can figure out how much of the
Oh,
company
40% of their fund. Oh my goodness. I thought that was they own 40% of the outstanding of
let me
Snowflake.
check if I can figure out. They own like $2.4 billion worth of the company. So, but they've got the big thumb in the room, right? They're the largest shareholder. They're the largest shareholder. So that CEO is not changing unless that large shareholder is on board, or maybe at that largest shareholder's request, who probably brought in the CEO, right?
Correct.
So they're in a tough pickle, and here's the thing about hedging. So we had a back and forth. He said, I said, look, year end, let's get together, compare returns. And I think we're going to do better than you guys because you guys took a bath on the Snowflake stuff. And he said, okay, at the end of year end, we'll do that. We'll get audited returns 23, 24, and we'll bet a steak dinner. So we'll see how that unfolds. I think we're ahead. I don't know how you can't be. So I appreciate the generosity, and he was very gracious in how he handled that. But here's the thing of it: there's no way you can hedge that kind of risk. Here's why. But if I can go Professor Ram, give me like a minute and a half on this one, right?
Please.
But there are two ways you hedge. Either you get a perfect hedge. The perfect hedge is expensive. What's the perfect hedge on Snowflake? It's hedging Snowflake with Snowflake, because you go short Snowflake. That's called selling Snowflake. Yeah. They didn't do that. We know they didn't do that. Or you buy put options. Put options are expensive. They cost like $20, $30 to hedge over the course of a year. That's expensive too. That eats into your return. If it's a conviction position, why would you hedge? Unless you're hedging your private position. But then your hedge fund is still exposed. Right? Exactly. So, or you hedge imperfectly and cheaply. So what does that mean? You hedge with like QQQ, you index hedges, or you hedge against other names in the category that you think aren't going to perform well. The problem is that they're not correlated. You get what's called basis risk. And so yesterday, Mr. Market's going up. Mr. Market's a meltdown. Mr. Market's up again, right? So that hedge didn't work. So it's ineffective. The hedge is ineffective, and you're paying for that hedge. You're losing money on hedges when they go the other way. And hedges generally cost money. There's no free lunch. So I don't know how the heck they hedged. It doesn't make sense.
Well,
yeah.
It's also, there's some other interesting wrinkles there. And like, this is my lawyer hat. I'm not your lawyer. I'm not speaking to you. I'm speaking to everybody. I'm not your lawyer out there. But so he's saying they hedged. Were they in possession of material non-public information about the condition of the company? Of course they were. They're a shareholder. They're the largest single shareholder. They're at the board meeting. They know that these earnings are coming out. Now, I'm not suggesting that they did anything inappropriate, and I'm sure that they thought about this, and there's never been any question about their reputation. My point is simply that you're in a challenging position when you know a company that you have a significant position in is about to massively miss earnings.
Right.
What are their rights to trade and hedge in other stocks as a result of this, right? I don't know.
Really?
It's a question that I would
so I just checked. So they're not on the board. Now, that's one. And two, again, I don't want to play anything on Twitter.
Oh yeah, no, not at all. It's just it's just a question, right? Like, you're trying to hedge. Why are you hedging?
Right.
Maybe they're just naturally hedged because their position is so large.
There are two questions I want to know. What did Ilya know about Sam Altman at OpenAI that caused him to take this crazy action? And the second question I want to know is, how did Altimeter hedge? Okay. These are the two questions that will vex me for a long time to come. And
those are good ones.
People want to know. So anyway, it's really fun. Like, there's a lesson in diversification. Diversification works. It does work. And I think with Snowflake, their strategy is concentrated bets. And a lot of people have that strategy. And Druckenmiller has this strategy too. Although he's got like 25 positions, right? But diversification does work, and you can grow wealth if you diversify in high conviction names. That's the thing, right? So
Yeah.
we have like 50 positions, for example. So we're diversified. Now we do have thematic exposures. We have sector overweights for sure, right? We're overweight semiconductors, nuclear renaissance, crypto, biotech, and we're underweight legacy brands in decline, for instance. Quick summary, what we're doing. But we love every single position that we own. And of course, even within those, we overweight names we prefer. And part of that is because you want to calibrate your factor exposures relative to the market. So we use portfolio construction and risk analytics statistical tools to help sculpt a portfolio. So we're not making implicit bets that are accidental. We want to be deliberate and conscious of all the factors and the risks that we own. Shake Shack could be correlated with some other name in the category for reasons we might not be aware of. Inflation might be linking a commodity supplier, for example.
Yeah.
Cost of beef. Cost of beef. Anyway, so it was really, I think it goes back to that. And, can you create wealth with diversification? I think the answer is yes, you can. What else? Did we cover good ground?
We did. We covered great ground. I think it's been an interesting week also. I think the one thing that was not on our list that I was thinking about this week is Bitcoin is back over 60, or it went back over 60. Is it over 60 now? It moves around a lot, so I don't know. But
I have it. I have I should get the Bitcoin watch or something like that. Yeah, no, I look at that every day. Look at that. We should do
the ticker behind you over that paste opening and have like a real-time ticker.
That'll be the top of the market when I do that. That I used to go to MBNA in Delaware, Wilmington. They were a client back when I was consulting. And when you walk in the lobby, they actually had a ticker, which was the credit card debt outstanding.
Oh, wow.
Yeah. And because when that number goes up, they make more money through lending, receivables, fee income, interest income, blah, blah, blah. And they took a bath on 2008 on all that stuff. So
yes,
but yeah, we should do something around Bitcoin. I think we will soon. I think next week, Nick Rigel, we might have a midweek show or end of week show around crypto wealth management on chain, non-custodial. Super excited about that. We're definitely one of the first advisors in the world to offer this service as a quick preview. And the thing about crypto is we're not trading it. You make a good decision when it's on sale and you buy it. That's how we approach it. There's some other things we do around crypto. I think crypto venture, there's some interesting plays here and there. And some liquid strategies are even more interesting, I would say, at this point in the cycle. But yeah, no, I mean,
it's interesting though to see BTC and ETH kind of get back to this place where, you rewind the tape, and when SBF shits the bed, you kind of look at those markets and think, whew, man, how long is it going to take for the prices to return and the confidence to return? And I don't know that we're there with the confidence, because there's still a lot of people who, they change their mind about digital assets and they may never come back. But asset price has returned.
Asset prices have returned. The ETF inflows combined with call buying, which creates this gamma squeeze, and Alex Thorne and Kelly at Galaxy Digital written a lot around this, plus shorting. That trifecta is pushing this higher.
And when's that happening?
Yeah, good. Say again. Oh, happening is I want to say like 50 or 45 days-ish, plus or minus. It's coming soon.
Coming.
You're not going to see like an event on the count. If you put Bitcoin on a chart, you're not going to see like, boom, like, oh, there it is. That won't happen. But you will see Bitcoin miners impacted in their revenue. So the quarterly earnings for these companies are going to be notable when they come out. But that dynamic though of inflows, number one, plus two, call options creating a gamma squeeze, and three, a lot of shorting. that's propelling certain stocks higher as well. So Carvana, MicroStrategy, even Coinbase, and scores of other stocks in the equity market. So it's the same dynamic. It's like you have this, a lot of capital trying to short these names, but they're going up because inflows. Where are the inflows coming from? From all the money that was scared in the money markets in 2022. They're trying to find a home back. That's like the equivalent of these ETF inflows. And retail investors are back. We saw that through Coinbase earnings and Robinhood earnings last quarter. They got back in at least November of last year. And so you're seeing animal spirit excitement is coming back. You've seen biotech stocks. We'll talk about biotech maybe next week as well. We have too much to talk about. So yeah, it's really interesting. Yeah.
Awesome.
Second.
Yeah.
Awesome.
When's the signal to get nervous though when the retail investor comes back?
I think, look, from a broader perspective, this tactics are one thing. They're leaving tactics aside. Broader perspective, when we see a lot of IPOs in public equity markets, we have Reddit coming up soon. Reddit's probably going to enliven things, actually. We'll see how that's received. When IPOs are oversubscribed, there's a lot of price bumps on these IPOs, not unlike what we're seeing with earnings now. Like to see double-digit earnings bumps overnight is highly unusual. Hasn't happened in years. That's a sign of speculation. And I think that call option creating this gamma squeeze dynamic. Someone's got to research that's my hypothesis. I don't know if that's for sure, but I believe that's the case. Then, but if you see a lot of IPOs, a lot of supply of stock hitting the market, then Mr. Market gets full and can't hang on anymore. And then there's some disillusionment. You get missed earnings. This happened in 21. Remember the SPAC craze? You had all these IPOs go to market. There was a lot of excitement, and then disillusionment, and then earnings aren't hit, and then things turn south. You go from multiple expansion to multiple compression. Right now, people are bringing the fuse. Same thing in crypto. So airdrop season's coming. A bunch of companies raised money in crypto, not companies, DAOs, protocols, decentralized organization, whatever you want to call it. They're going to have airdrops second half of this year. The early airdrops are motivating, actually. They're exciting, and they draw people in. Just like in DeFi summer, we had Compound and then Uniswap opened people's eyes to free money. People made like $45,000 on the Uniswap front. They held it for like 9 months or a year, whatever the math was. So I think we're still in the excitement phase, but when you see too much frenetic airdrop activity, we'll all know it. We'll all see it there. Hopefully we're conscious of it because we're not caught up in it like the fish in water. Hopefully we can step out of the fishbowl. But I think near year end, we got to reassess. Look, it's an election year. You got 6%, you got wartime deficits. You got fiscal spending out of control. All of that's actually bullish. I'm not saying that's good for the economy. I'm not saying there are not consequences to that. I'm not saying to support these policies.
Main Street and Wall Street are not the same.
Right. Exactly. Shall we leave it there?
We shall.
All right. Perfect. And happy birthday again, Justin. Make it a great one.
Thanks, sir. Appreciate it. Have a great weekend.